How are assets dealt with in small business valuation? Why do they feature prominently in some valuations and not others? In video 2, we discussed the overriding principle of small business valuation. A business is worth the sum of its future cash flows, as long as this is greater than the value of its assets. Based on this principle, businesses whose assets are worth more than the sum of their future earnings will be valued based on their assets. Of all the different situations where this can apply, and all the different types of assets, they all fit into one of only two categories: where the sum of the future cash flows is low, usually because of a low multiple, or where the asset value is very high. That's basically it. In all other cases, the valuation of the business will be based on its earnings. Before we look at the valuation methods, let's think about the kinds of businesses that this applies to. The most obvious cases are asset sales, businesses that are closing down or have closed down and are selling their assets. Insolvency situations are similar. Assets need to be sold to pay back creditors. Other businesses are profitable, but extremely reliant on the owner. Their personal brand drives all of the company's business, and without them, the company's future earnings would be negligible. It's often difficult to sell these businesses at all, and if they do change hands, it's for the value of their assets only. A business might be profitable, but very small. When a realistic multiple is applied, accounting for risk, the total calculation of its future cash flows is quite low, lower than the value of its assets. With very small shops, restaurants, and takeaways, this can sometimes be the case. The future cash flows are worth less than the equipment, fixtures, and fittings and the opportunity to take over the lease. If they're family run, the key staff will also usually not be staying on after the sale. So instead of using the PE multiple method to calculate the value, the owner will use the asset value as a starting point and add on a small premium for goodwill. The asset value is what drives the valuation in these cases. The lease can be one of the assets. We'll come back to this shortly. Other businesses are very capital intensive and have a lot of fixed assets. Manufacturers, transport companies, and rental companies are examples of businesses that hold lots of machinery and vehicles. For small businesses in these sectors, using a multiple appropriate for their size gives a valuation that's close to or even less than asset value, not because their profits are low, but because the asset value is so high. Selling for asset value only is an option, and in many cases this is the reality, but it's more of a last resort for the owner. Thankfully, in these capital-intensive industries, there's a third option, a hybrid valuation method incorporating both earnings and assets. In these specific industries, the market will often pay more than asset value, and accepted rules of thumb exist for this reason. For example, small trucking companies in the United States and other countries are often valued at 2 to 3 times EBITDA plus assets. This formula compensates the owner for assets as well as a multiple of future cash flows. Variations exist such as 3 times EBITDA plus vehicles. We've seen 2 times EBITDA plus assets. In the end, it comes down to negotiation. But the principle is that in these industries, when a business is quite small and only a low multiple would be applicable, the market will often bear a premium on top of this for assets. So to summarize the situation in these capital-intensive industries, when profits are strong, the valuation will be based on a multiple of earnings. When the business is smaller and the multiple of earnings alone would give a low valuation, the seller will argue that the valuation should be based on a hybrid of assets plus a multiple of earnings. And often the market will pay this. But if a buyer can't be found at this price, the valuation will revert simply to the asset value alone. The seller will never sell for less than asset value. In these cases, he will either sell the business as a going concern but for asset value only, or just close the business and liquidate the assets one by one on the open market. Some businesses hold a great deal of assets in real estate. We looked at some of these in the last video on rules of thumb. Small hotels, B&Bs, care homes, freehold pubs, all of these businesses have significant property assets. Their valuations are still calculated in the traditional way. They're based on earnings, using the PE multiple method. The only difference is that with these industries, the multiple tends to be higher than other small businesses, as we saw in the last video. However, sometimes the value of the property in these businesses starts to exceed the value of their future cash flows. This can either be because of falling earnings or quite often because of rising property value. In these cases, the value of the business is really the value of the property itself. So a specific type of asset valuation, a property valuation, determines the value of the business. Some businesses can be separated from their property. They can be relocated to rented premises without much of a problem, and the property can be sold off separately. Or they can stay on in the same location and rent the property from the new owner. When the property is separated from the business like this, the property will have one value, and the now separate business will have its own value based on its earnings. Other businesses are dependent on their location and can't be relocated without efforts equivalent to starting from scratch. In these cases, when the property value is greater than the valuation given by the earnings multiple method, the business is usually sold for the property value, and the business itself may be closed down because the buyer wanted the property for a different reason. For example, in the UK, only 50% of freehold pubs that are sold continue to be used as pubs. The remainder are used for other purposes, most commonly residential development. So although the business sold as a going concern, the buyers were interested only in the property, not the business. Clearly, the property value drives the valuation in these cases. So how do we actually value the assets of a business? In some cases, it's relatively easy. Wherever there is a liquid market for the assets, like vehicles, the valuations are pretty straightforward. Assets like kitchen equipment are traded on marketplaces like eBay, so it's relatively easy to estimate their values quite accurately. The value of stock or inventory is normally based on its purchase price, although the purchaser will usually try to negotiate a discount on the stock compared to the full price, especially where the stock is perishable or will be obsolete soon, like fashion or technology. This is reasonable and simply comes down to negotiation. Unique items like fixtures and fittings can be based on a percentage of their original purchase price if comparable products can't be found on marketplaces. But again, much of this comes down to negotiation. Hiring a professional valuer or appraiser with experience in your specific asset classes can be very helpful, particularly where the asset values are high and the costs of error can be significant. Expert valuers can be very helpful in providing a view on the value of used machinery, for example, or specific inventory. Intellectual property assets are particularly difficult to value. Industry experts can be consulted, but the valuations will always be subjective. Most small businesses don't hold IP like patents and trademarks, but some do, especially in the creative industries and in technology. In some cases, the value of this IP represents the bulk of the value of the company. Reputational assets like trading history, search engine rankings, reviews, and testimonials can be very important for a business, but they're very difficult to value. These assets will contribute to a higher PE multiple for a business when it's valued in the traditional way based on its future cash flows, but they'll usually not be valued as separate assets in their own right. Similarly, long-term contracts will usually contribute to the overall impression of the future earnings potential of the business and result in a higher PE multiple. Importantly, these assets can result in a higher likelihood that the business will sell at all. Contracts can be valued as assets in their own right, but this is not very common. Leases, on the other hand, are contracts that do often have asset value in their own right, particularly for shops and restaurants. If these can be assigned to new owners, and if they are unique and will give the new owner an advantage, they'll have value. A common example is where a small restaurant or a takeaway business is selling before the end of its lease. If the location is desirable and the rental terms are lower than market rate, and if the contract allows for the lease to be assigned to a new tenant, then new tenants will be willing to pay a premium for the opportunity to operate a business at this location under the same lease. Rarely, the owner will close down the business, liquidate some of the assets separately, and then look to assign the lease to a new tenant, effectively charging a premium for this favourable lease, as well as any fixtures and fittings that are left in the shop. More commonly, the owner will look to sell the business as a going concern, with all of the fixtures, fittings and equipment bundled together with the lease and goodwill as one unit. Larger, successful restaurants and shops will be valued based on their future earnings, as we've discussed. But for very small shops with relatively modest profits, where the valuation based on future earnings would give a very low number, the valuation will be driven by the assets. If the lease itself is considered desirable and can be assigned to a new tenant, then this will be one of the assets, and the owner will charge a premium for this, along with the premium for the goodwill in some cases. The eventual sale price will be negotiated, of course, but the assets will be the driving factor in the value in these cases, especially the lease if it's particularly desirable. The exact premium that can be charged for the lease can be calculated using complex formulae similar to the discounted cash flow method. They basically add up the future savings offered by the beneficial lease and convert them into a present value. But in practice, this premium is simply based on how much the market will bear. Comparables can be useful in this regard. Comparing the leases that have been transferred on similar properties in the same area and the premium they were able to achieve will give you a good idea. Commercial estate agents can give you an indication of this value, although the usual caveats around using agents should be followed. Bear in mind that if an owner is closing down his business and the lease he is looking to assign is actually unfavourable, in other words, the rent or terms are higher than market rate, or the location is undesirable, he will have to pay someone to take over the lease from him. He will have to pay them a reverse premium. Rather than an asset, the lease is a liability in this case. One other point to note with shops and businesses that have a lot of stock, particularly perishable stock, this inventory is usually added to the valuation at the end. These valuations usually state the suffix plus SAV, which means plus stock at valuation. Adding the inventory value at the end simply allows everything else to be negotiated first without worrying about the stock level, which will fluctuate on a daily basis. The value of the inventory can also be negotiated, of course, but this is left to the end in these cases. Let's look at some examples. Firstly, a small takeaway business. Let's say it has a turnover of £120,000 with a realistic adjusted net profit of £20,000. It has assets valued at £45,000 excluding stock. It's in a desirable location and has a favourable lease at less than market rate with 5 years remaining. The valuation in this case would be based on the asset value plus a premium for the lease. So this would be £45,000 plus the premium, which might be estimated at £30,000 based on local market conditions, giving a value of £75,000 plus SAV. Now, depending on the stock level, the total price would represent a 4 to 5 times multiple of earnings, which is more than an investor would usually pay for such a small business. But in this case, the buyer would be paying for the assets plus the opportunity offered by the lease. If they believed they could generate more profits by running a different business at this same location, particularly if there was a scarcity of suitable properties available, then the investment might be worth it. If the owner can't sell the business on these terms, he has the option of liquidating the assets for £45,000 plus whatever he can get for the stock. But he will still be committed to the landlord for the remaining term of the lease, and he'll have to negotiate with the landlord to terminate the lease. Now let's look at a trucking company. Let's say it's in the United States and it has a turnover of $1 million and EBITDA earnings of $100,000. Let's say it has an asset value of $350,000. Based on this, the valuation would be, according to the rule of thumb that we discussed earlier, 2 to 3 times the EBITDA plus the market value of the assets, which would be 2 to 3 times the $100,000 plus $350,000, giving a valuation of $550,000 to $650,000. Now again, buyers will bring this back to a multiple of earnings. So this would be equivalent to a 5.5 to 6.5 times multiple of EBITDA. Whether or not the business will achieve a sale price within this range, or possibly even above, will depend on the characteristics of the business itself and how well the sale is handled. But if a buyer can't be found at this price, then the asset value of $350,000 will set the floor price for the negotiations. Now, there are some tax and employee considerations that could change this slightly, but generally speaking, the owner will not usually sell below this level, since he could liquidate the assets for this price. Now, let's look at a freehold pub with an EBITDA of £110,000. In this case, the property is valued at £1.25 million, and the business can't be relocated, at least not without efforts that are equivalent to completely starting from scratch. Now, the rule of thumb in this industry is for a pub to be valued at a 5 to 9 times multiple of its EBITDA earnings. The exact multiple within this range will depend on the characteristics of the business and the characteristics of the property itself, including how well it's been maintained and how much the owners have invested into it. But this is the range. So in this case, this will be 5 to 9 times the £110,000, which will give a valuation of £550,000 to £990,000. But occasionally, the property value alone will start to exceed this range, as is the case here. The property market has caused the value of the property to rise to £1.25 million. The owner will not sell for less than the property value, of course, so the value of this business becomes the property value, which is £1.25 million. Now, at this price, the purchase would represent a multiple of more than 11 times EBITDA. If this happens, the eventual buyer will likely not intend to continue running the business as a pub after the sale, since he or she will have been interested in the property itself rather than the business. Remember that in the end, from an accounting perspective, any price paid for the business in excess of the tangible asset value represents the goodwill. So whatever the circumstances, whether it's a hybrid valuation in the case of the transport company, or maybe a traditional PE multiple valuation that gives a number greater than the asset value, or maybe in the case of the shop, a premium is charged for the lease. In every case, an accountant will simply call this the goodwill. So while we can have our reasons for stating why a business is worth more than its asset value, to an accountant, after an acquisition, none of these reasons matter. The buyer has simply purchased tangible assets and goodwill. It's sobering to remember that this goodwill is purely theoretical. A good case must be made by the seller for the buyer to buy it. And in a successful sale, from the seller's point of view, most of the value will be in the goodwill, like this. But if a buyer is going to pay more than the tangible asset value for a business, then he has to be really confident in the future earnings that he's buying and the opportunity that this represents. Before any buyer does this, there is one other type of valuation they'll almost always do, the entry cost valuation, With this method, they'll calculate the costs of starting an identical business from scratch, including buying assets of the same quality and quantity, and developing the business to the exact same state as the target they're considering acquiring, as an alternative instead of buying the business. If it will cost less to start a competitor from scratch and buy the equivalent assets, or in the case of a strategic buyer, to grow their own business by the same amount as the acquisition would add, and if the time frame is acceptable, then it would be rational to do this instead. In reality, it's unusual for a realistic entry cost valuation exercise to show a favorable outcome. In most cases, the time, expense, work, and even luck involved in getting a business to an advanced state is worth paying for, rather than attempting to replicate it from scratch. But it's worth bearing in mind that this form of asset valuation will be conducted by most serious buyers. So in summary, when the assets of a business are worth more than the sum of its future cash flows, the valuation will be based on the asset value. This can either be because the sum of the future cash flows is low, or the asset value is high, or both. Asset values can be particularly high in capital-intensive industries, where hybrid valuation methods are often used with small businesses, adding asset value to a low multiple of earnings. Businesses that hold a lot of inventory also typically add the inventory to the valuation at the end. But in all of these cases, the business will not usually sell for less than the asset value, because the owner has the option to liquidate the assets for this price. Also, remember that regardless of the valuation method, buyers will always want to calculate the payback period on their investment. In other words, they will bring back the total valuation to a multiple of its earnings.